Thanks for joining us today for today's webinar. All right. Today's topic will be a very interesting topic. We'll be looking ahead to 2023. Is this the start of the next bull run? And I think this is a very important question that a lot of us have on our minds as well. So my name is Jason. I'll be moderating today's session, right? And a little bit about who the speaker will be. I think it's a very familiar face, one that we're all very familiar with. Ritesh, Head of Investment Advisory here at Syfe. So Ritesh actually leads, he actually plays dual roles. He leads the advisory team and he also spearheads the investment committee as well. So formerly a private wealth advisor at Goldman Sachs, and he actually holds an MBA at the prestigious Chicago Booth School of Business as well. Right. So for those of us who are joining us here for the first time in our webinar series, I'll be sharing in the next 5 minutes a little bit about Syfe, what we do, what we stand for, right? Those of us who have been joining us on a very regular basis, you'll be pretty familiar, right? And just stay tuned for the next 5 minutes for this particular aspect. So a little bit about Syfe. We're actually a digital investment platform with an MAS license. Here in Singapore as well as Hong Kong. And I think our core mission here is we want to actually empower our clients to be very confident of their financial investments here at Syfe. So a lot of the tools, a lot of the engagement sessions that we have is geared towards that mission per se. Right. So on our platform, if you have the mobile app, you can actually see two different categories, the Syfe Wealth and the Syfe Trade. So Syfe Wealth is more geared towards a long-term wealth planning purpose per se, right? And the Syfe Trade is more towards a DIY brokerage where you're looking to have like single stock selection. So here at Syfe, we do take a holistic approach to our clients' financial portfolios, and we do see that our clients will actually require both platforms in order to have a very, very holistic overview. So this is why we actually have two different platforms. Right. A little bit about our journey year to date. So we actually launched in July 2019, right? And it's been a pretty cool 3 years plus thus far. One of the things that I always like to highlight to my clients is our customer range itself is very, very diverse. So we have like 18 years old all the way to a 94-year-old male itself. So just imagine the range that we are actually having on our client base itself. Right. So we do thank our clients for their support. Right. In 2022, we actually launched Syfe Trade, right, and it actually became Singapore's top brokerage as well. Right, we reached 100,000 users in Q1 of 2022. Right, so definitely a pretty exciting year for us this year. So obviously in 2023, this chart will actually strengthen and will become wider as well with the support of all our clients. Right, so maybe I thought today, let's kickstart with a quick poll just to get a feel of how everyone is feeling about 2022. How everyone is going to be feeling about 2023. Right, so Vivian, if you could just pull up the poll questions. So I think a few quick questions, very, very short 3 questions, just to get a feel on the ground. First question, do you think 2023 will be a bull or a bear market? Right, and then the second question, which one would you be interested in terms of the thematic aspect? And then some of the key concerns that you have for 2023 as well. So I'm just going to pause here very shortly and give you guys some time to actually think through this. All right, thanks a lot, Vivian, for the poll responses. And I think pretty interesting, Ritesh.
Very interesting, yeah. I'm happy to see there are more. Actually, oh no, it's the reverse. Actually, people are more bearish in the market than bullish. So definitely very interesting. I read it the other way around. I think my mind is geared towards it's been a difficult year this year, so things should reverse. But obviously, investors have been bitten pretty bad with both the equity and fixed income markets. So I can imagine why the general sentiment might still be negative. In terms of thematics, it's interesting to see, interest in China, real estate. These are also, for example, China has been battered down quite badly over the last couple of years. So good to see that resurgence in interest. And in terms of concerns, I think this is more in line to our expectation as well, right? Inflation, recession, geopolitics. These are some of the key concerns.
Yeah, definitely. So I actually put it over here in this slide as well. Some of the key concerns that come up to the top of our mind. So like market outlook for 2023, what kind of investment strategy that we'll be employing in 2023, recession, as well as like inflation. I think all these are pretty much at the top of my client's mind also. I'll pass the time over to Ritesh, right? And I think it'll be a pretty exciting.
All right, awesome. Thanks, Jason. Thanks for the introductions. And let's move over to the next slide to talk briefly about the agenda. So today we will be covering these sections, right? We'll take a quick snapshot of the market. We will look at the economic outlook as we stand right now. We will think a little bit deeper in terms of what kind of investment strategies we can pursue, given the outlook, given what has happened by taking a review of 2022 as well. And then we'll move over a little bit more towards Syfe, our platform, our portfolios, and how have they fared so far in 2022, and also a little bit of an outlook from our perspective as to what we believe will happen as we move forward. We will also intersperse this with Q&A. So as you guys go through our session today, if you have any questions, please feel free to type them out. Jason will collate them, and hopefully we should be able to answer as many of them as possible. All right, so let's start. Okay, so we'll first cover the market snapshot. So let's move over to the next slide. So obviously this year has been disappointing for investors in public markets. Both the equity and fixed income investments across the globe have fallen quite sharply after showing pretty strong returns, particularly for the equity markets for 2020 and 21. Really, it's been a story of inflation, the related Federal Reserve policy in terms of interest rate hikes, and also kind of exasperated by things like the Russia-Ukraine war, associated energy crisis, and with the continued volatility in the Chinese markets. These have all resulted in like drawdowns in equity markets across the world, with most of the major indices going through some sort of a bear market phase for the bulk of 2022, right? So if you can see in this chart, most of the major indices corrected by over 20%. And it's only like the last 2 months when we've seen some recovery. Overall, even at this point of time, roughly we are down, close to 15 to 20% on major indices. So S&P 500, MSCI World. But if you look at the more thematic indices or region-specific indices, then you look at China. China has fallen much more, and that's part of things that we'll cover. And also thematic sectors, technology sectors, growth-oriented sectors have fallen much more than the overall market. And that's been, again, a catalyst to that has been the fact that the interest rates have risen quite aggressively. And when interest rates rise, then very high growth companies, which are priced in with pretty high price to earnings ratios, those valuations kind of readjust because now the discount rate is much higher. So that's one of the reasons why you see high growth companies and technology companies showing much negative returns for the bulk of 2022. And these were the same kind of sectors which did incredibly well in 2020-21. Now, will that persist? And is this story of value versus growth? Only time will tell. But overall, there was also a distinction between the different markets. So when you look at technology or growth-oriented companies, profitable growth versus non-profitable growth, there was a dispersion in returns in those perspective as well. But even on a broader index level, there is a bit of an underperformance of the, say NASDAQ 100 when you compare it to S&P 500. Now, of course, the last 2 months, we've seen the US markets kind of recover and with back-to-back monthly gains. One of the first since 2021 that we have seen 2 months of positive gains through October and November. So S&P 500 was up 5.4%, while the tech-heavy NASDAQ composite was rising by 4.4% in November. And the same indices climbed by 8% and close to 4% in October. So back-to-back gains for 2 months. So definitely things have brightened up. And the reason is, while the Federal Reserve delivered another 50 basis points rate hike yesterday, the market hopes have been a bit brightened with inflation numbers coming down. So 7.1% is the latest print that came out, which was much below expectations, and which could mean essentially that the end to the rate hike cycle is not very, very far off, right? So that's the, reason why the markets are coming off these, drawdowns and recovered, like, some of the specific markets like China and all have recovered more than 20-30% during this time frame. All right, so let's move on to the next slide. Overall, though, like when you look at returns, not just for the equity markets, but other asset classes as well, basically this year, there has been no place to hide, right? Like, barring, say, energy and crude, and if you invest into, the FX market and more specifically in a dollar denominated manner, then the US dollar index has risen. And again, that function was because of the Fed interest rate hikes. But beyond that, everything else just had a fall through. And even like the energy asset class, if you see Brent crude, while the range of returns was quite positive, the current state is a bit more muted, right? Like so it did have a pretty high return framework, or the price of crude oil rose close to 150 through the middle of the year as the Russia-Ukraine prices peaked up. But now the current rates are much lower. But if you even go other asset classes, safe haven, which is supposed to be gold, while it fluctuated between positive and negative, right now it is slightly negative. Overall, if you look at the fixed income market, negative, US equities, global equities, emerging market debt, all of them have had negative returns. And there is basically whatever you use as traditional diversifiers will not really help you in terms of generating some sort of uncorrelated returns in this kind of an environment. So it's been really challenging for any investor, and whether you are in equities, bond, gold, it's been a negative year more so. All right, so let's move over to the next slide. So yeah, so I mean, like this is very interesting because like what has made 2022 especially challenging is the whole 60-40 conundrum, right? Like these portfolios are supposed to be designed in a way where equity and fixed income are supposed to be oppositely correlated. But this has been one of those years where equity and fixed income both fell in tandem, making it again very, very difficult for people to diversify their portfolios. And again, just to look at this chart, essentially the negative stock bond correlation has persisted for over 25 years, right? And it was kind of the linchpin which helped to simplify portfolio construction, right? 60-40 is something that is used as a base for any portfolio construction. And this portfolio kind of reversed in face of this persistently high inflation numbers, as well as a very aggressive Federal Reserve interest rate hiking cycle. Now, as of mid-October, the year-to-date return of a portfolio with 60% US stocks and 40% US treasuries is nearly minus 20%, right? And there have been only 3 calendar years in which the annual performance of this kind of a traditional portfolio has been worse, and all were more than like, say 70, 80 years ago, which really calls into question whether the 60-40 portfolio is kind of dead, right? So that's a big question that has been, thrown around. And we will come to it in our subsequent sections as well. But there has been question marks being put in whether 60-40 really works, is bond true diversifier or not? And will this, opposite correlation start to come back as we move forward? So we will talk a little bit more about that in the outlook part of this session. But before that, let's take a quick look on the economic outlook. So Jason, if we move forward. All right, so obviously inflation is still high, but it is moderating, right? The latest inflation print showed that on a year-to-year basis, inflation hit 7.1%, a slowdown from the 7.7% rate that we saw in October, and lower than 7.3%, which was expected by analysts, right? It is the smallest 12-month increase since December 2021, when, back then it was, 7%. And also on a monthly basis, if you see the inflation prints, it's climbed by just 0.1% compared to the previous month. And this was, if you look back in the October and you compared it to the previous month, which is September, so the month over month has also started to, trend down, because in October it was 0.4% month over month increase. Now it is 0.1%. So definitely the trend is showing on the downside. And if you look at this forecast as well, there are potential situations where the inflation numbers should continue to, move. Now, if you look at more from a Federal Reserve outlook standpoint, a rough estimate of where the central bank officials feel where they can pause their current hiking cycle. This was issued alongside like yesterday when the rate hikes happened, and where basically when you look at these, the economic projections show that there can be an extended battle with inflation that is still to come, and with near recessionary conditions developing, as we move forward. So these are, again, fears in the market that are cropping up as, the inflation numbers still persist. I mean, they're coming down, but we are still not sure if there is a trend or not, right? So the Federal Reserve is assessing that trend. Inflation from their perspective is seen to remain above their 2% target. So, if you see 7.1% versus the target is 2%, so it's good news that the inflation is coming down. But, if they want to hit the 2% target, at least by the end of, say, the next couple of years, it will be a, pretty hard task for them to keep the interest rates not at a reasonable level, right? So they have to keep hiking it to see that inflation numbers have a persistent trend to come down. And one of the goals that they have set is like by the end of 2023, if not 2%, they can bring it down to 3%. Overall, some of the other leading factors that also affect the market's sentiments is basically, if you can just go back, Jason, so unemployment rates, that can be seen to rise to 4.6%. Right now, the unemployment rates are still pretty good, but over the next year, it's expected to reach 4.6% from the current 3.7%. So that's an increase, which is, exceeds the historical levels and kind of pricing in a little bit of a recession that might happen as we move on to 2023. The US GDP is also forecasted to slow down. So while this year we've had a decent GDP print, next year the GDP is supposed to contract to 0.5%. And the same that was kind of estimated for this year before it can rise back to, say close to 2%, which is the long-term economic, activity that the Federal Reserve expects. So that's, close to 2%, which we can expect maybe 2024 and beyond. Now, if we move on to the Wall Street forecasts, this is very interesting because, what we tried to do was just to put together all the big banks and what their forecasts are in terms of GDP, in terms of inflation, in terms of, other aspects, because essentially if we put together what all of these guys are saying, maybe we can come to some sort of a consensus view, right? And what the consensus view tells us is basically that the global economic growth is expected to slow down further, right? So as I said, 0.5% was the Federal Reserve expectation. But if you look at some of the prominent names here, such as say Morgan Stanley, it sees the Federal Reserve delivering its first rate cut by 2023 December, right? So while the inflation number trend down and Federal Reserve keeps on increasing the interest rate, there is a hope that the interest rates will reach a peak somewhere in the mid of 2023. And then towards the end, there will be, Federal Reserve will start cutting interest rates once, the inflation is in a range that is acceptable to them. So from that perspective, there are certain houses which expect a more mild form of recession and certain houses which, think that there will be a hard landing. Now, overall, the general sentiment is that towards the second half of next year, you will start seeing, at least the peak, and then potentially by the end of the year, you will see at least one, rate cut such that the economic activity can be spurred back for 2024 and beyond. All right, so that's a quick snapshot of the Wall Street forecast. If we move over to the next slide, of course, the big question is, it's been a bit tough environment right now. Whole of 2022, equity markets down close to 20%. This has basically called into question things like, are we headed to another lost decade? Now, just to give you guys a perspective, a lost decade is a period of, negative to almost zero returns, right? There have been two previous episodes where we have encountered such situations. And the current markets have been compared to the situation more prominently to the 1970s, where there was hyperinflation. And because of that, for an entire decade, the equity markets generated close to 0% returns, right? And the previous episode before that was, the Great Depression and all. So while there has been a comparison, the similarities between the situations back in 1970s and currently are indeed a bit hard to ignore, right? Since 2020, when the coronavirus hit us, the Federal Reserve has pursued very easy monetary policies, and with bringing the interest rates down to zero, doubling its balance sheet to close to $9 trillion. And coming into this year, we are seeing decades high inflation, which was, as I said earlier, exasperated by the Russia-Ukraine war, rising commodity prices, China's kind of uncertain COVID policies, as well as supply chain disruptions across the globe. So that really brings into the question that, given all of these similarities, are we going back to the 1970 situation where there'll be a decade of, zero to no returns? And obviously, that's a bit concerning. Now, our view is a bit different. We believe that the current situation is not the same as what happened in the 1970s. Central banks, governments have learned from their lessons of the past. The Federal Reserve has signaled its intention to continue its aggressive rate hiking policy to tame inflation and prevent a run of inflation rates into double digits as it happened in the 1970s, right? So we covered all of these aspects in the previous slides as well. The Federal Reserve has been relentless in its pursuit to make sure that the inflation can be controlled, and even at a cost of a little bit of a recession, right? On the other side, the unemployment numbers still remain pretty strong and below 4%. So that's been encouraging because, while there are recessionary concerns, the ground reality and leading indicators are still very, very positive. Overall, the US consumer index also kind of jumped over the last few months, defying these recessionary concerns. We're also hopeful that the Federal Reserve will be able to achieve a soft landing through its policies with a kind of milder recession, if any, and still keep the long-term growth prospects on track, right? So that's kind of a view that we have in terms of how the situation should evolve. And based on the actions taken by the central banks, it is highly unlikely that a lost decade, such as the ones that happened in the 1970s and before, is going to repeat. All right, so if we move on to the next section, we'll talk a little bit more from a perspective of how do we think about our investment strategies as we move forward. So Jason, if we move over to the next section. So, obviously the market's not been great so far, but when you look at valuations, there is a silver lining, right? The, markets have been falling, but overall, compared to 2021, where the valuations were versus you look at the valuations in the current scenario, it's way, way different. Things like government bond yields, credit spreads, equity valuation multiples now generally look close to or below the average levels seen over this particular period. Lower valuations today also translate to higher expected returns in the future. So this is something for people to note that yes, the valuations were pretty high coming into 2021, the later half of 2021 and coming into 2022. But given the corrections, the valuations now look very, very attractive. And that basically means when the valuations look attractive, the forward-looking returns, the expected returns as we move into 2023 look, much, I would say, encouraging compared to where they were. For fixed income, there is a pretty strong link between yields and expected total returns. Higher government bond yields and increases in credit spreads for both investment grade and high yield bonds have moved long-term expected returns to investors higher as well. Lower multiples also imply more space for positive increases in the future. And this has kind of boosted equity returns in similar markets, right? So, previously, if you had these similar situations, usually there is a boost to equity returns. Also, I think while the US market is still, has had its preeminence in terms of overall returns, the current valuations also suggest that there are potential opportunities that investors can look at beyond the US market and into the international domain as well. If you then port it over to your traditional 60-40 portfolio, I think this is the big question, right? And this is the question that we had asked, like, is the 60-40 portfolio dead? Because, if you look at 2023, the correlation framework just broke down and equity bond portfolios suffered, if not worse, almost similar negative returns as an all equity portfolio, right? So the diversification benefit did not really work. Now, if you look at what we covered in the previous slide, where essentially the valuations across the board look very, very attractive, combination of, a rising bond yields and falling equity valuations means that expected returns have increased sharply for multi-asset portfolios as well, right? And, investors who are looking to generate particular kind of nominal returns levels, over the long term, they potentially now you don't need to invest into very risky assets, right? You can still have a pretty moderate allocation to a, say, 60-40 portfolio. And this 60-40 portfolio can generate you returns. And this is, again, expected returns. The expected returns for a 60-40 portfolio has changed from, close to like 3.5% back, last year to close to, 7.2% this year. So this is like real nominal expected returns that you can imagine as you move forward with a moderately allocated 60-40 portfolio. So if you are a more aggressive investor, the return should potentially be even higher, right? But the point really is, while the 60-40 portfolio has been called into question, the fact is, given the drawdowns, given, what is happening to the interest rates, eventually the levels at which they are trading is much more attractive. And because of that, the forward expectations of returns should be much, much higher. And potentially at a much lower risk that investors need to take. All right, so if we move on to the next section, this is a very interesting slide. I tried to, put this slide together mainly to kind of give forward expectations with some sort of a scenario analysis, right? Because there could be different market situations that can evolve over time. So the 4 different situations that we have laid down here is like a deep recession that happens, a stagflationary environment, a Goldilocks kind of a scenario, or a reflationary environment. Now, each one of them do have a meaning, right? Like a recessionary, deep recession basically means low inflation, but also low or negative growth, right? So that's really, deep in recession. Stagflation is a period of sustained above trend inflation. So very high inflation, but low growth, right? So low growth, high inflation is what a stagflation is. Goldilocks is a situation where basically there is a moderation of inflation alongside, above trend growth, right? So the growth is still pretty high. And reflation is an environment where inflation is high, but growth is also high, right? So it's really the 4 corners of inflation versus growth. Now, the situation over here is like, when you look at 2 years versus when you look at 5 years, there is obviously more uncertainty when you look at a 2-year return forecast. And again, putting together like a 60-40 portfolio, the range of possible outcomes can be pretty wide in a shorter term time frame, right? So, this particularly like, if you look at the Goldilocks kind of scenario and reflationary outcomes, the expected returns are still, high single digits. And only in the event that there is a deep recession or stagflation, the expected returns are negative for a 2-year period. So this is again a 2-year period where usually it is a little bit more harder to predict, how the different sort of asset classes will behave given different kind of scenarios. But when you put that together from a little bit of a 5-year time frame, stagflation is the only scenario when the expected return are supposed to be negative in a real, return standpoint, with, a prolonged positive stock bond correlation that kind of challenges performance in all parts of the portfolio. But, and again, to kind of remind you, stagflation basically means like above trend inflation and below growth, right? So this is a situation where potentially there can be, negative outcomes in the equity markets or even in a 60-40 kind of a portfolio. But if you look at, from all the other scenarios perspective, the 5-year expected annual returns are kind of modestly positive, even in a deep recession scenario, right? It's, not very good, but it's still positive, while the expected annual returns are, close to that 5-7% range that I talked to you about in the previous slide. if there is a Goldilocks or a reflation scenario. All right, if we move over to the next slide, this basically talks a little bit more about while we should not discount the fact that a 60-40 portfolio is still the base for a lot of investors. And that's definitely, in our opinion, also where anyone starting off their investment should begin their journey. But yes, I mean, there are ways to further diversify, right? So for retail investors, usually who have access to only long-only strategies, that's where you can look at some of these other asset classes to not just from a, risk standpoint, but also from a return enhancing standpoint, right? So, while the traditional 60-40 is composed usually of, say, equity and fixed income, if you add things like real estate or REITs, if you add things like, bank loans, debt, high yield, even infrastructures and MLPs, these are kind of diversification strategies that can help you to kind of enhance your returns and go beyond that 60-40, right? So maybe you start off as a 60-40 portfolio, but you can use these other diversifier to kind of enhance your overall returns from a longer term standpoint, right? And again, if we go back to, the way we think about the markets and how you should be constructing portfolios, we really think of it in a core satellite, standpoint, right? So the core should be more of a traditional portfolio, and then you layer it with these diversifiers as satellites that can help you, enhance returns as well as potentially reduce drawdowns. All right. If we move over to the next slide, I think one important point that again I want to put in place is markets on a year-to-year basis are difficult to control, but patience is something that still remains our best bet. And we talked about the situation where potentially, are we headed into another lost decade? I don't think so. There have been multiple bear markets, and bear markets essentially mean more than 20% drawdowns in the last 150-year history of the US stock market. And it's on average every 3.5 years. So every 3.5 years, you will have a bear market that you need to go through. So this is, just one of those different cases. But in each of these cases, the market has eventually recovered and then went on to make new heights, right? Despite drawdowns, some of which were quite long and severe. Dollar, if you look at this chart, a dollar invested at the end of 1870 grew to $20,000+ in real terms by the end of May 2022. This is a real annual return of close to 7%. And more recently, from the lows of the previous lost decade, which was, say, from 2009 to May 2022, the market is up more than 400%, right? So it's up more than 400%, even accounting for some of the drop that you saw, start of the year till mid of the year, right? So essentially, what you will see is if you move on to the next slide, yeah, so basically, we basically are saying that stay in the race, stay invested, don't lose hope. The average length of a bear market is usually, on average 350 days, so maybe a year. But the average length of a bull market is close to 1,700-1,800 days, right? So that's like more than 5 times the average length. And at the same time, while the average loss in a bear market is close to say 30-35%, the average gain that you get in a bull market can be as high as 180%, right? So that's the average gain across all these bull markets. So again, while it is very hard for me or anyone to predict how long it will take for the markets to recover, panic selling is something that we should really avoid, right? Like, and you can see this again going back over the last 2 months, like people who got into that fear and liquidated their investments mid of this year, they have not been able to participate in any of the rally that we have seen over the last couple of months. And that is what is very important, because even if you miss a few days or a few weeks of positive returns, that can have a pretty meaningful impact in terms of your long-term returns. And this is something that, when we talk to clients, we try to embed into them as much as possible, because, when you are thinking about your retirement, you don't need the money right now. Why do you need to, take these actions when, you might not be the expert as to, when exactly is the right time to time the market. Let's move over to the next slide. Yes, so I guess alongside that, what we also wanted to talk about was a little bit more of an active view, but something which could be interesting from a standpoint of, how does different sectors behave when inflation is high, but it is on a trend that is falling, right? So if you look at this slide, it maps out sectors that have usually generated positive returns when the inflation numbers are high, but it is starting to come off and it is falling, versus certain sectors which don't do that well when this kind of a situation unfolds. So really, if you think about it, there are the healthcare sectors, the medical equipment, semiconductors, pharma, banks. Some of these sectors tend to do pretty well when inflation is high, but on the trend down, versus some of the other sectors, which are like consumer durables, oil and gas. So oil and gas have had a decent run, but you're already seeing oil and gas, sort of coming off. And then again, going back to like chemicals, mining and minerals. These are all kind of sectors which had the highest positive returns for the bulk of 2022. But as inflation, starts to trend down, some of these will have some headwinds associated with them as well. Okay, let's move over. I think the next section is about China, right? So this is very interesting because essentially China is something that has impacted a lot of investors, especially people who have been invested into the Chinese market, and with a persistent negative return for close to 1.5 years. And that has again led to a lot of investors ultimately giving up on China and removing those allocations altogether. However, if you look at just the last 1 or 2 months, the investor sentiment on China has also turned bullish. And especially in November, MSCI or the MCHI ETF, which tracks the MSCI China index, it rose by close to 32% in just a month. And then more specifically, the KWEB ETF, KWEB, which basically tracks the overseas China internet index, it jumped by over 48% in just a month, right? And this is in comparison to the MSCI World Index, which only grew by around 7%. So again, positive returns, but in comparison, the returns of the Chinese markets just dwarfed the returns for all of these markets. And this outperformance that you're seeing is one of the largest outperformances since 2000, right? And the question is, what has really sparked this rally? The rally has been sparked by hopes that there will be a faster exit from the zero COVID policy in China, as well as the government's responses, the recent positive responses with COVID and property market measures as well. And again, this is kind of a turn of the corner, in my opinion, given the strong underperformance of the Chinese markets over the last couple of years, which was really led by these lockdowns, which weighed on the recovery in the property sector, despite, there was continued policy easing. But again, all of these things did have an overhang on the equity markets in China. So if we have to map out, what has been happening in China a little bit more in depth, if we move over to the next slide, what has been the chief reasons why the Chinese markets has been so volatile? So it's a sum of all fears, right? We did this webinar with Crane Shares where they shared some of these, things with us. And essentially things like US-China political relations, the geopolitical risks, within China. There are, all these question marks with respect to ADRs or, foreign denominated securities listed on the US stock exchange, and whether they will be allowed to, keep trading or not. China's own sort of zero COVID or dynamic zero policy, COVID policy, the interest rate kind of regulatory cycle within China, and the general economic outlook there as well, remaining a little bit subdued. But if we look through the hoods, if we go on to the next slide, it basically, people have been saying that now China has fallen out of favor and it is kind of uninvestable. But if you look through the details, what you'll realize is China and emerging markets have provided outsized performance. But if you know where to invest, right? So if you know the right place to invest, then there are parts of the market which have really outperformed and shown through and over multiple years, right? So the light blue line basically talks about the MSCI China Information Technology Index, which has kind of dwarfed all other asset classes, all other equity markets, going back to 2009. Similarly, if you go to the next slide, there's also perception differences, right? When you look at the local onshore Chinese market versus the offshore Chinese market, the investor perceptions about China change significantly as well. And that also results in return dispersion too. So when the primary investor is a mainland China investor, then the returns are, less subdued. Like you look at 2021 till now, it's, sort of almost, I would say, negative, but like not as negative if you look at just the offshore market, which is down by close to 60%, right? Like, you look at the last line, which is the CSI Overseas China Internet Index. The last year has been, pretty catastrophic and the index has fallen by more than 60-70% over this period. So obviously the sentiment is very different when it comes to offshore market versus the onshore market. And this is one of the reasons why we also believe, while there might be still some uncertainty about these regulatory environments, COVID policies and all, the geopolitical risks, as well as the stock listings and other things as we move forward from an international investor perspective. But the local dynamics look to be much, much different, and things look to be in much better order in that view. All right, if we keep moving on. So what does the outlook look, going forward? Basically, there has been the party congress, and it translates into going back to business for the Chinese policymakers. Zero COVID policy has been relaxed. It is slow, but there is hope that 2023 will be the reopening year for China. Real estate support has been building over, after there has been like the 16-point plan, which was released on 11/14. Q3 earnings seasons is upon us as well, and China's internet platforms, they continue to grow their revenues, deepening the discounts offered by their share prices as well. And Chinese economy could be entering a recovery phase as monetary and fiscal policy becomes more accommodative, right? While the rest of the world tightens. So while we are on a tightening cycle across the world, China is on a policy easing cycle as we move forward. All right, I think, yes, let's take a pause, given that it is 5:45. As usual, overrun a bit, but I will take a pause now. Maybe we can take a couple of questions, Jason, before we move over to the Syfe section.
Yeah, definitely. I think, so pretty interesting. I think one of the questions that popped up was, in comparison with the previous decade where low interest rates, we were looking at double-digit returns overall. Do you think that moving forward the next decade itself, are we looking at the same double digit, or are we looking at more towards a single digit returns itself?
Yeah, I think that's a great question. Now, of course, I am on the camp where I would say I don't think there'll be the same double digit kind of returns that you saw, through 2009 to, bulk of the decade, and then continued. I mean, it continued through 2021. I don't think that will be the case going forward, given the federal policy and the interest rates will move towards a higher denomination, right? The decade of 2010 and 20 was kind of dominated by these growth-oriented sectors that really propelled the equity markets to kind of multi-year highs. So while the correction that we see right now obviously presents opportunities, but in terms of forward-looking returns, I still feel the forward-looking returns will be more high single digits versus, the double digits that investors had experienced in the previous decade.
Okay, thanks, Ritesh. I think in the interest of time, let's go to this section. I think this Syfe performance review is also a pretty interesting one. So I'll hand it over back to you.
Sure, absolutely. So let's move, right? I think just before starting off, I'll quickly go over, what our suite of products are. So obviously most of the, viewers today must be knowing about all our offers, but people who are joining in for the first time, we have a whole suite of offerings ranging from the wealth side all the way to active, trading side as well. On the wealth, we have basically, a few buckets. So our core portfolios are designed for long-term investing. These are for your long-term goals, such as retirement, child's education, buying a house. And depending on your investment time horizon and risk appetite, you can choose between a defensive portfolio, a balanced portfolio, a growth, or a very, aggressive equity-only portfolio, right? And these are built using equity, bond, gold. So this kind of goes back to our discussions of, those traditional portfolios, which are 60-40. We obviously have commodity or gold as additional diversifier built into within the core portfolio. but this is kind of our core building block when it comes to portfolio construction. And then we look at satellite strategies, right? And this is the part where we talked about how you can first start with a core portfolio and then add these layers on top such that you can enhance your overall returns. So REITs is one of our most popular portfolios. It tracks the IH S-REIT Leaders Index. It is built in partnership with SGX. And currently REITs for this year has outperformed the equity market. So while the equity markets are down 15 to 20%, REITs are down close to 10%. And from a yield standpoint, they're currently yielding one of the highest yields amongst asset classes within Singapore, so close to 6.1% at this point of time. We also have certain thematic portfolios. So if you're looking for mega trends, we talked about certain sectors, China, other themes as well. We have portfolios such as that available within our thematic investment bucket. So if you are having an active view on any of these specific themes or sectors or countries, you can kind of express them using our thematic portfolios. We also have our custom portfolio builder. So in a way, these are portfolios that we discretionarily manage, the core REITs thematic. But in the custom portfolios, you are able to choose your own underliers and construct your own portfolio from scratch. So we give you that power and control. Of course, we have our cash plus portfolio, which are now yielding 3.0%. So this new projected yield will be updated as of tomorrow. But yeah, I mean, our cash plus portfolio has been very, very good for investors looking for safe haven amidst the kind of market crash that we have been seeing in 2022. And then on the trade side, of course, now we have access to both the US and the Singapore market. So you can trade across, stocks, REITs, ETFs, and directly buy individual securities, things that you have high conviction on. All right, so let's now go to the interesting part of covering how our portfolios have fared for this year, right? So this is basically covering some of our, key offerings, so core portfolios as well as our REIT plus portfolios. In terms of performance, if you look at 2022 year to date, so the column somewhere in the middle, our equity 100 portfolio is down 13.75%. These are all numbers in USD terms. So 13.75% down versus the benchmark that we follow, which is MSCI World, which is down 14.65%. So roughly 1% outperformance compared to MSCI World for core equity 100. Of course, our core balanced and core growth portfolios have underperformed the respective benchmarks for this year. One of the key reasons for the underperformance is because from a duration and bond exposure standpoint, we are a bit more tilted towards the longer duration side of the bond market, which means that when the interest rates are on an accelerated path up, our portfolios tend to underperform. But if you look at all the things that we discussed and going into 2023, when interest rates are supposed to peak as well as potentially come down in the second half of 2023, then really these are the kind of portfolios that should kind of outperform and should give you much better returns compared to the traditional benchmarks as well. Of course, the defensive portfolio has, again, overall remained in line with the index, so not too much to do, sort of differentiate at that point. Beyond that, as a diversifier, if you look at our REIT plus portfolio, as I said earlier, down 9.5% compared to the index that we track, which is the IHS REIT Leaders Index, which is down 10.9%. This is as of November 30th, 2022. So, our REIT 100 portfolio has outperformed by 1.4%. And from a standpoint of dividend yield, it is at 6.1%, right? So, compared to the equity market, which is down 13-14%, of course, the REIT market has had a limited drawdown. I mean, of course, you cannot completely ignore the fact that inflation did go on a hyperdrive towards the September-October period. And while REITs were, pretty much flat for the year till, say, about August, once the inflation numbers kept creeping up, that's where, you saw some drawdowns in the REITs markets as well. But overall, as we move forward, if some of these things are coming under control, we expect that the REITs market should recover much faster going forward too. If we go on to the next section, quick recap of our cash plus portfolio as well. So cash plus portfolio has really been the shining star for us. It's been one of the best managed cash solution in 2022. If you compare it against some of our, peers as well, it's performed very, very stable. It's, given the yields that it had promised versus, there were certain other cash management solutions which had components which ideally should not be part of a cash management solution, in my opinion, right? They had short duration oriented components. So if you're looking at a cash solution which you need for more near-term needs, then those are not the solutions that will, give you a very, consistent, stable return profile. And that has been the intent for us, right? Like, when we thought about our cash plus portfolio, we took a conscious choice that we will not go for very high headline yields. Rather, we will construct our portfolio in a way such that the returns remain very, very stable, predictable, and investors get that confidence that they are investing into this. Their money is kind of safe, right? So if you look through the whole year, the returns of our cash plus portfolio with respect to what we project. So, every time through the year, we project a certain return for our cash plus portfolio. And then through the period where we are projecting those returns, we also measure ourselves and see if the actual returns of cash plus is in line with what we projected or not. And as you can see throughout the year, the cash plus portfolio has delivered much better return than what was projected throughout the year. And right now, as the interest rates keep going up, yesterday there was another 50 basis point hike. So we are raising our cash plus projected rates to 3% now, which is fairly attractive, I would say. And while there are options that are available in the market, such as fixed deposits and SSBs and T-bills, which are potentially giving a little higher rate than our cash plus solution at the current juncture. But the fact that it is super liquid, you don't have any, minimum holding period associated. There is no minimum subscription that you require. All the flexibility that you get, it is, I think, a still very, very attractive solution as we speak. And plus, as we move forward, while our cash plus portfolio does have a lag in terms of catching up with the interest rate, I believe, the cash plus portfolio should yield close to 4% as we move into 2023. All right, and then I guess we just share the webinar promo codes as well, Jason.
Sure, yeah, but before we do that, I just wanted to add a quick note that is pretty interesting. Like in the 1st of January, we were actually at 1.2%, and now we're actually at 3% already. It's pretty amazing.
Yeah, and that again, goes to show overall how aggressive the Federal Reserve has been in terms of raising its interest rate across the board.
Yeah, exactly, that's right.
That has really translated into higher returns for cash.
Yep. All right, so I think this one is the part where most of us will also be interested in.
Yeah, so I mean, everyone who's joining in today, this is a quick kind of appreciation for you spending the time with us today. People who are new to the platform can use the first promo code, which is webinar, to get up to 3 months of fee waived for up to 30,000 of investments. And folks who are existing clients, you can use the promo code at the bottom to get fee waiver again for any top-ups, and with the minimum being $5,000 as well. With that, I guess we are ready for some Q&A.
Yes, definitely. So I think to follow up on the previous question, given the fact that the China market itself is tilting towards a more bullish aspect, so do you think that we should be actually looking to overweight China in our portfolio allocation now?
Right. So look, I think overall as a economy, China is kind of underrepresented in most of the global equity benchmarks. So when you look at things like MSCI All Country World Index or MSCI World, the allocation to China is only around 4 to 5%. But when you look at China's economic contribution to the world, it is close to 18 to 20%, right? So that's the economic contribution that China has in terms of GDP and purchasing power parity. That's the kind of impact that China has on the world economy. So from that perspective, China is kind of underrepresented in most of the global indices. And that's why in our core portfolios, when you look at the China allocations, it roughly ranges between 3% in our defensive portfolio. And that's mainly because it's a very bond-heavy portfolio versus the equity 100, which is a 100% equity portfolio. The China allocation is already around 15%. So it is much more in line with the global kind of from a GDP weighting standpoint. We believe we are ahead of time in terms of how we think about China versus all the traditional indices. We use it as a factor in our portfolio construction process. But at the same time, what I would say is we are not tactical about it. It's a strategic asset allocation, meaning that usually it will remain pretty stable over time, right? So I don't expect China to go to like 25-30% of our portfolio. It will, in my opinion, remain between 10 to 20% over time.
All right, thanks a lot, Ritesh. I think in the interest of time, it being 6 p.m. right now, of course, we want to continue this much longer, right? But let me just do a quick wrap up of today's session. Once again, if you have any questions, feel free to send it to us.
Or connect with all our advisors, right? I think everyone has access through our mobile app. If you're an existing client, you can reach out to our advisory team and follow up on any of the things that we covered today. As well as if you have some more specific questions personal to you, then I think it warrants a more one-on-one conversation as well.
Exactly. Couldn't have said it better myself. All right. So if not, then thanks everyone again for joining us this evening. Hope you have a pleasant night ahead. Thank you very much.
Yes, and happy 2023 to everyone. Look forward to a better 2023 than 2022. So hopefully much more positive.
Definitely. All right. Thanks.
All right.
Thanks everyone.
Thanks everyone.
Yes.